Again, welcome to this week's office hours for ESG and ESGCV. My name is Shavonna McCaleb, and I am today's moderator. If you are just joining us, please go to the chat and introduce yourself with your name and the region you represent. As a reminder, this office hours session is being recorded for public record. Office hours recordings are on the California ESGCV past training webpage. A copy of the slide deck and recording will also be emailed to you. Next slide, please. How to ask a question. All questions must be submitted in the chat box. Please type your organization and question into the chat box. The team will read questions out loud at the end of the presentation and will provide answers, if possible, throughout the presentation. All questions and answers entered into the chat box will be recorded as part of the public record. Alongside our presenters, we also have several HCD staff, including ESG representatives, ESGCV grant administrators, and other consultants who are able to answer questions during the Q&A session. Next slide, please. Today's office hours session agenda includes the following: ESG, ESGCV update, office hours update, upcoming trainings, ESG, ESGCV question and answers, Q&A, and today's spotlight session, income evaluation for rapid rehousing and homelessness prevention. Next slide, please. And now I will turn it over to Anthony.
Thank you. Good morning, everyone. I hope everyone had a great long holiday weekend. Don't really have any updates today, but we do have a few reminders, as you see on the slide, regarding the contracts and the contract years. The 2022 ESG award, those contracts are anticipated to be routing in July of this year. And for the 2023 ESG annual NOFA, stay tuned. It's right around the corner. We will be releasing that in June of 2020. And the weekly reminder that the expenditure deadline for the 2021 contracts is August 31st of this year. So let us know if you need any assistance there in getting your RFFs in and get the proper timing. Next slide, please. And as always, I'd like to point out that we have our ESG policy document page. It's very helpful, constantly being updated. And in particular, for those of you who are going through annual monitoring this year, it's a great source of information in getting your files prepared and any policy questions you may have in advance. Next slide, please. If you do have questions, you can contact your ESG representatives, Diana Prado, Giovanni Martinez, Tuesday Cool, and myself. And there's also the ESG NOFA helpline, or the email. You can send us an address there as well. Next slide. And that is it. Thank you so much.
Thank you, Anthony. Reminders for performance milestones. All program funds for Project Street Outreach, Emergency Shelter, Rapid Rehousing, Homelessness Prevention must be expended by September the 3rd, 2023. All funds for HMIS and administrative costs shall be expended by October the 31st, 2023. Final requests for funds must be submitted to the department by November the 15th, 2023. Next slide, please. Here's just a few reminders while planning for ESGCV closeout. Spend down timing. Know when you're approaching the end. Know that most funds are due to be spent by 9/30/2023. So don't spend too fast, but time it right. Funding continuity. Consider HAP funding and other funding streams that will allow you to continue to serve clients after closeout. Closing intake. Set dates and deadlines to stop accepting clients as well as client intake and prepare for final rapid rehousing assistance. Staffing issues. Just like we need to make sure we are not leaving participants with nowhere to go, we also need to make sure we are thinking of ways to keep staff employed. Client issues. Make sure you involve and inform participants timely before assistance ends so they can prepare as well. No clients should become homeless because a program is closing. Next slide, please. Upcoming office hours topics on 6/7, policy smorgasbord on 6/14, CLC, collaboration requirements on 6/21, duplicates of benefits and supplementation, fraud and risk management. Below, you can view links to register for future office hour sessions and to view past recordings. Next slide. This is also upcoming trainings for June. Please use these resources as needed. Next slide, please. This is also more resources for upcoming trainings for June. Next slide, please. At this time, we will take any questions. You may put them in the chat box. Okay, it doesn't look like we have any questions. Next slide, please. How to contact us. If you have any further questions, please contact us. You can contact your annual ESG rep. Please reach out to your annual ESG representative or use the ESG NOFA at hcdca.gov email. And for ESG CV, please reach out to your grant administrator. Next slide, please. And now I will turn it over to our presenters for today's office hours session topic.
Well, good morning, everybody, and welcome to this week's presentation. We'll be covering income evaluation for rapid rehousing and homelessness prevention. My name is Kristen Delkamp, and my pronouns are she, her, and I am an ESG CV grant administrator for California HCD. And then my compadre here, Michael Thomas, would you like to introduce yourself?
Sure thing. Thank you. I'm Michael Thomas. I use he, him pronouns. I am a lead homeless services specialist with ICF. Happy to be here with you again this week. And oh yeah, the first slide's mine. So we can go to the next slide and we can jump right in if you're ready, Kristen. All right. So we're going to talk about income eligibility or income evaluation today. So the first thing I want to touch on here is when that happens. So we're talking about this specifically for the homelessness prevention and rapid rehousing components of ESG. So income eligibility has to be evaluated at intake for homelessness prevention programs. It has to be reevaluated not less than every 3 months if you have annual ESG funding for homelessness prevention, or not less than every 6 months if you're using ESG CV for homelessness prevention. So there is a difference there. And then finally, it must be evaluated not less than every year for rapid rehousing projects. And so if we move on to the next slide, I will show you this in a slightly different format. So for rapid rehousing, and we repeated this on this slide in a different format because it's really important to understand the difference here. For rapid rehousing, income evaluation is not required at project intake, but it must be evaluated no less than annually if the household is in the project for over 1 year. So when you hit that 1 year mark, it does need to be evaluated. At the annual evaluation, the income must be below 30% of the area median income for the household to continue receiving assistance from that ESG rapid rehousing project. That is with annual ESG. If you're using ESG CV, then at annual evaluation, the household income must be below 50% of the area median income to continue receiving assistance. So again, there's a difference in the income limit for annual ESG and for ESG CV. For homelessness prevention, income must be evaluated at intake. It is upfront. Households must meet that qualification to initially enter the program. And then it must be reevaluated no less than once every 3 months, or 6 months for ESG CV. At intake and at each reevaluation, income must be below 30% of the area median income to continue receiving assistance. There is a slightly different thing in the federal guidance around ESG CV, but California HCD policy sets this at 30% for both annual and ESG CV funding. So 30% AMI is the limit for homelessness prevention. Next slide, please. So a few notes on income limits that you need to pay attention to. When you're looking at the income limits on the HUD website, the extremely low income, that is not what you want to use. That is not what applies to ESG. There is sometimes confusion there. ESG uses the 30% area median income limits. That's a separate thing, and you must reference the right tables that contain those 30% AMI amounts. If you were to use the extremely low income amounts instead, you could end up admitting people into your project that are not actually eligible. So income eligibility is based on the income limits in effect at the time of income verification. That's another place where people get confused sometimes. If your contract was executed last year and HUD has now moved on to the next set of income limits, you are using those current income limits when you take people into your project now. So you're using the ones in effect at the time of verification. So again, it is not based on the income limits that correspond with the grant year under which ESG funds were awarded. That's not how it works. Next slide, please. And over to you, Kristen.
Thanks, Mike. So let's talk about the definition of annual income. Annual income is defined at 24 CFR 5.609, and it means all amounts, monetary or not, which go to or on behalf of the head of the family or spouse, even if temporarily absent, or to any family member, or are anticipated to be received from a source outside the family during the 12-month period following admission or reevaluation, and which are not specifically excluded. More details on that on the following slides. Annual income also means amounts derived during the 12-month period from assets to which any member of the family has access. So generally, the subrecipient must use current circumstances to anticipate income. The subrecipient calculates projected annual income by annualizing current income. Income that may not last for a full 12 months, for example, unemployment compensation, should be calculated assuming current circumstances will last a full 12 months. If changes occur later in the year, an interim recertification can be conducted to change the family's rent. Next slide, please. So subrecipients must count all income of family members approved to reside in the unit, even if some members are temporarily absent. The amount of assistance paid on behalf of the family is calculated using the family's annual income, less allowable deductions. HUD program regulations specify the types and amounts of income and deductions to be included in the calculation of annual and adjusted income, which we're going to review now. Starting with gross amount of payroll for wages, salaries, overtime, commission, fees, tips, bonuses, and other compensation. Net income from the operation of a business. And a reminder that net income is gross income minus business expenses, interest on loans, and depreciation. Interest, dividends, and other net income of any kind from real or personal property. The full amount of periodic payments from Social Security, annuities, insurance, retirement funds, pensions, disability or death benefits, and other similar receipts. Regarding Social Security payments, include payments received by adults on behalf of individuals under the age of 18 or by individuals under the age of 18 used for their own support. Payments in lieu of earnings, such as unemployment and disability compensation, workers' compensation, and severance pay. Welfare assistance payments from TANF, periodic determinable payments such as alimony or child support, and on that, subrecipients must count alimony or child support awarded by the court unless the applicant certifies that payments are not being made and that he or she has taken all reasonable legal actions to collect amounts due, including filing with the appropriate courts or agencies responsible for enforcing payment. And finally, military, regular pay, special pay, and allowances. Next slide, please. So just as a reminder, subrecipients must count all income of family members approved to reside in the unit, even if some members are temporarily absent. However, there are income exclusions, which we'll cover now. Those include employment income of children under 18, payments for the care of foster children or foster adults, lump sums such as inheritances, insurance payments, capital gains, or settlement for personal property losses, amounts specifically for or in reimbursement of the cost of medical expenses, income of a live-in aid as defined by 24 CFR 5.403, student financial assistance paid directly to the student or educational institution, special military pay for exposure to hostile fire, temporary, non-recurring, or sporadic income such as gifts, and reparation payments paid by a foreign government for persecution during the Nazi era. Next slide, please. Moving on with additional income exclusions, earnings in excess of $480 for each full-time student 18 years old or older, excluding head of household or spouse. So when full-time students who are 18 years of age or older are dependents, a small amount of their earned income will be counted. Count only earned income up to a maximum of $480 per year for full-time students age 18 and older who are not the head of household or the spouse or co-head. If the income is less than $480 annually, count all the income. If the annual income exceeds $480, count $480 and exclude the amount that exceeds $480. Next, we have adoption assistance payments in excess of $480 per adopted child, deferred periodic amounts from SSI and Social Security or deferred VA disability benefits, amounts received by the family in the form of refunds or rebates under state or local law for property taxes paid on the dwelling unit, amounts paid by a state agency to offset costs of care for a member with a developmental disability to live at home, amounts specifically excluded by any other federal statute, and other uncommon items listed under 24 CFR 5.609C8. Next slide, please, and I will toss it back to you, Michael.
All right, thank you, Kristen. So now we're going to talk about how you document income. Next slide, please. So documenting income is relatively straightforward. The first thing you need is an income evaluation form containing the minimum requirements specified by HUD and completed by the recipient or subrecipient. So that's the program delivering the services. There is a note on this in a moment, so bear with me and I will get to that part. Along with that form, you also have to have documentation backing up what's on it. So ideally, that would be third-party verification. Third-party verification can be source documents for the assets that are held by the person that you're evaluating. So here you're thinking about documents that actually show those amounts of income. So wage statements, pay stubs, unemployment compensation statements, any kind of public benefit statements, bank statements. You see where I'm going with this. You're looking for those official statements for source documents. Or if those aren't available, then it could be a written statement by the relevant third party. So if you are able, or if you can't, for instance, get a pay stub for some reason, but you can get something in writing from the employer stating what their income is, that is acceptable. If you cannot get that, then written certification by intake staff of oral verification from a third party. So what we're saying there is, say you couldn't get the pay stub and you couldn't get the employer to write something down. If you could get the employer to verify orally to intake staff, then your intake staff member can record that oral statement and certify that they took it. So that's the gold standard, one of those forms of third-party verification, preferably in that order. Source documents first. If you can't get that, written verification. If you can't get that, oral verification. If none of that is possible, self-certification would be the next step. So to the extent that you can't get third-party verification, then you can get written certification from the program participant of the amount of income that they received for the most recent period that's representative of their income, and that shows what they would be reasonably expected to receive over the 3-month period following the evaluation. So that sounds complicated. What we're really saying is you would be getting self-certification. Like they can tell you, I made X dollars from X source in the last month. So you have that representative period. Then you can use that to estimate what they would receive over the next 3 months. And then for annual income purposes, that can be annualized. So that's what we're saying with self-certification. You are having the person applying for services give you a statement on their current income, and then you're using that to determine what that annual amount would be. Next slide, please. So some source document examples. We talked through some of these, but I like to reiterate, there are a lot of things you can use for source documents. Again, we're thinking wage statements, paycheck stubs, unemployment statements, public benefit statements, bank statements. This is not one I have seen in the HUD guidance, but I have been adding it in recently when I talk about this. Think about statements from things like money transfer apps, because we are increasingly living in a gig economy, and that makes it necessary to consider documenting income received through money transfer apps and gig work and things like that. You should also note that gig work pay can be volatile. So when you're considering that as income, remember that their income must represent a reasonable estimate of the income that they will be receiving in the future. So take that volatility under consideration when you're estimating income based on that type of income source. Next slide, please. So here's my note on the evaluation form that we talked about, that first thing that is required for documenting income. Regulations, specifically the ESG program interim rule, states that documentation must include an income evaluation form that contains the minimum requirements specified by HUD. In practice, though, HUD does not have a standard form or checklist to document a program participant's income or eligibility under the ESG program, nor do they have a list of the required elements for such a form. So ESG recipients and subrecipients must document income using an income evaluation form of their own design. So really, you're just putting together a form showing that you are looking at all of those potential sources of income, and you're using that to assess the person's annual income level. So again, while the regulation says that you need this form, such a form does not actually exist from HUD. So you have to use a form of your own design. Another option, next slide, please, is using HUD's income eligibility calculator. That essentially produces a version of what will be on a form for you. This is perfectly acceptable. You need that supporting documentation to go along with it. So if you're putting in that a person has X amount of employment income, then you need the pay stubs to back that up. But what you get from the income eligibility calculator can be included as the HUD required form, if you will. So we've got a link here that'll be in the slides when they go out. It takes you here. You have to sign up for a HUD Exchange account if you don't have one already. But when you go in, you can just click here, and then there's a number of steps that you go through to identify where you are and the size of the household that you're evaluating. You put in their income, and it'll tell you if they're eligible for whichever program you're evaluating them for based on what you tell the calculator. Next slide, please. That was a pretty quick presentation. That is all we have, but we have plenty of time for Q&A. So I know we have one question, but I will take a quick pause to see if Kristen, if you would like to add anything.
No, I am good. Let's just jump into Tuesday's question there. How about that?
Sounds good. All right, so Tuesday's question, how will AMI be affected if moving clients from ESG CV to annual ESG? How will AMI be affected if you're moving a client, from ESG CV to annual ESG as ESG CV is coming to a close? So I'm going to talk about it in terms of the two separate project component types. So rapid rehousing first. With rapid rehousing, you don't have to do an income assessment at intake. So you could transfer a person straight from ESG CV to annual ESG rapid rehousing. If that person gets to the annual limit in the annual ESG program, then they will have to be evaluated for income. So at that annual mark, they will have to meet the 30% AMI requirement, just like anyone else in an annual ESG rapid rehousing project would. For homelessness prevention, It can be a little trickier. However, because the California HCD policy says that the income limit is the same for ESG CV and annual ESG, it's not quite as complicated for you. Someone could be transferred straight from ESG CV prevention into annual ESG prevention. But then when they hit that 3-month mark and they have to be reevaluated, they are going to need to meet that 30% limit. Did I answer your whole question there?
Yeah, I think you did. Thank you.
Yep.
So we had another question come in, and it was, if the ESG program is being entered into the HMIS, can you use the LASA income calculation worksheet? Mike, I have not seen the LASA income calculation worksheet, so I cannot speak to that. Can you?
I am not familiar with it either, so I can't explicitly say. However, if it contains all of the information necessary to accurately calculate income, it seems like it could be an option, but I don't want to say specifically yes or no because I'm not familiar with it. If any of my colleagues are, I would welcome you to add to that.
We have another question from Julie. Would this income inclusion amounts paid by a state agency to a family with a member who has a developmental disability and is living at home to offset the cost of services and equipment needed to keep the developmentally disabled family member at home be included in IHSS income for a family member that is a caregiver?
Mike, I'm batting that one to you.
Yeah, I think that one is more specific than I'm going to be able to speak to. So I do not know. I would suggest that you reach out to if you're using annual ESG, you reach out to your ESG rep, or if you're using ESG CV, reach out to your grant administrator, and they can help you figure out the answer to that one. That one is just too specific to California, and I am not sure. Sorry.
Well, thank you for that. Hopefully that will help. From Marche, if a rapid rehousing participant is in the program March 31st and their exit is November, to confirm there will be no need for an income verification in the file. Or can we confirm that there will be no need? Upon audit, will that mean income verification is not needed as they did not meet the annual due date? Or speaking as a compliance specialist and want to ensure our files meet the standards fully?
That is correct. Rapid rehousing only requires income verification at the annual mark unless there is a more strict local standard included in the local ESG written standards. That is possible. I don't know if that's the case where you're located, but if there is not such a standard, if you don't have a stricter local ESG written standard, then that's correct. Rapid rehousing only requires that at the 12-month mark. And so if a person is in the program for less than that, you would not need to have income verification.
I'm glad you gave that reminder, Mike, about the more stricter policy, because oftentimes I do think that we forget about that. We have our, we know the rules, but if there is a stricter policy, we have to follow that more strict policy. Thank you. And right now, we're not seeing any more questions. Is there anyone that would like to come off mute and ask their question? We do have time.
Looks like Veronica's got her hand up.
Unmute yourself. There you go, Veronica.
Okay, I just wanted to make sure it was okay. Hi. I apologize if you addressed it. I've been a little busy. But did you guys, or can you talk a little bit about how to include or exclude payments received by tribal members for like per capita payments. There may be a better term for it. I didn't see it in the income exclusion, so wondered about that one.
Yeah, I mean, the income exclusions we presented were straight from the regulation. So if it's not in there, shouldn't, I would imagine it's not included.
Okay. Thank you.
Also want to note from earlier, Chris did give me a link to that LASA form, and I have not been able to look at it with any intensity, but I can say just from first glance, it looks perfectly fine to me. As long as you're looking at all the required income sources, it seems you can plug in whichever income sources you need there. So it looks fine to me.
Thanks, Chris and Mike. And Marche says, thank you for the answer to her question, because she'll review the standards in California, but she really appreciates the information.
I think I just saw another one pop up.
I was going to say one more question from her. What would be the source for local ESG requirements?
It's going to be, depending on what collaboration looks like in your area. Well, now let me not get too complicated. It's going to be either the local ESG recipient. So if you're in an area that has an ESG recipient other than the state of California, like a local entitlement area, they could have local written standards. And then if you don't have that, you're going to be using the California HCD policies. And, as far as I remember, in the California policies, there is not a stricter standard on rapid rehousing. So it's really going to be only if you're in an area that has a local ESG entitlement. So if you don't have that, you're good. If you do have that, you probably want to check that it's possible for a continuum of care to put things like this in its written standards, but it's not entirely common for them to do it for ESG.
That being said, we certainly have seen that through monitoring. And as Mike mentioned, if you have set a stricter standard for yourself, you have to be held up to that standard.
Yeah, thank you for flagging that. Given that that has been seen in monitoring, I would suggest you check with your local continuum of care as well.
From Richmond, what can we do if landlords are reluctant to provide necessary forms for an ESG program participants' rental assistance?
Well, I'm not seeing the connection with income, but if you're speaking generally, I think that building those relationships with landlords is one part of it. Making sure that you've got good relationships with landlords will help to lead them down that path. And if not, there are going to be some items that are required by the program or by federal regulation. And if that's the case, they unfortunately don't really have a choice on that. What comes to mind for me immediately is VAWA or lead-based paint. So I think you've got to rely on your relationships that you've built with the landlords, because there's no getting around those requirements.
Yeah, I think that's completely accurate and in line with other subsidy programs too. Landlords are either willing to work with the requirements to get those subsidy payments, or they're not. And that landlord engagement and those relationships is really the key.
Is it upstairs or downstairs?
Thank you, Mike and Kristen. Not seeing any more, but before we rush off, we want to allow you to ask whatever questions you may have. So feel free to just come off mute. You don't have to raise your hand. Just come off mute and ask your question, if there is one or two.
Okay, well, if there are no more questions, thank you, Mike and Kristen, for a great presentation, and thank you all for your questions. Remember, a quick survey will launch as you exit the session, so please don't hesitate to include any suggestions you may have on that survey. This survey will help HCD provide useful content and needed technical assistance and training. Have a great day, everyone, and thank you for joining us.